everybody, hello. I have the distinct pleasure of having a real talented professional. And I want to set the stage just a little bit here. On a Saturday about a month ago, I decided, for the sake of my family, I really want to know what Toby does. So I registered for, true story. I registered for one of your webinars and I made it about 3 hours in. And mind you, way back when I had a client that was worth almost $300 million, had the family foundation, had the charitable remainder trust. I helped him walk through all of that with Merrill Lynch Trust Company. Toby, your firm, you guys know what you're doing. I was a little bit lost, and there's no doubt you guys are very, very talented. So
thank you.
Anyway, so folks, today we have with us Toby Mathis, whose firm is Anderson Legal Business and Tax Advisors. You can read a brief bio about Toby, but Toby, why don't you take a couple of minutes? And I'd like to hear in your words a little bit about the firm that you started.
Yeah, I appreciate you having me on, first off, Ted. And we love working with Spartan. Ryan's a stud. We've had you guys out. Ryan was the one who came out to Hawaii with us and did one of our retreats. So it's really fun to work with folks that are kind of cool and mellow and easy to get along with. We don't have much patience for the carnival barkers out there. So it's good. I became an attorney, what is it now, 25 years ago, and I've been trying to make up for it ever since. So I always say I'm doing my penance. No, I became an attorney because I didn't really like attorneys, and my mentor said to his son and me, you need to become attorneys so that you know how it actually operates. You don't get taken advantage of. He was a very successful business guy. He tried to go to law school, but he got kicked out within 6 months just because he was a little bit opinionated. But the son is a fantastic attorney, does ERISA law down in San Francisco, and I do this. I've been partners with somebody I went to school with, now Clint Coons, for more than 2 decades, and we have about 400 employees here. We teach all over the country, and we put into practice exactly what we teach. We're all investors. Clint and I are well over 400 properties. I've been investing. Clint grew up doing apartment buildings, and I tend to really like the single family area, though we still have mobile home parks. We have commercial properties. We have warehouse space, a couple office buildings, but I still love the single family space. I still think you're able to help more people that way, and that's why I do it. And then there's the right way and the wrong way to do things. So we teach people how we do it, and how to minimize your tax, how to maximize the benefits and minimize the risks of whatever you're doing. It's really not too difficult once you've done it for a while. It actually seems like second nature. And then you're always shocked when somebody walks up and says, why do you do it that way? And you're like, well, because of this, this, and this. I'd never heard that before. And you're like, well, come hang out with us for a little while.
Yeah. Come spend 8 hours on a Saturday. So when you mentioned you have 400 attorneys, I'm going to guess you can cover everything from soup to nuts, from estate planning to.
Yeah, it's not 400 attorneys. It's 400 professionals and administrative staff and everything. It's a lot of CPAs, a lot of EAs, a lot of bookkeepers, a lot of attorneys, a lot of just professionals that have gone up in the investment world. We work only with small businesses and investors. So it's not like we're going out there saying, hey, I'd love to do your 1040. We do about 7,000 business returns, and we'll do the individual's return as well, but we don't want to do the 1040s. We like the 1120, 1120S, the 1065s, the 990s if you're doing philanthropy and you're doing the nonprofit side.
The 550s?
550s or 5500s for the, we will do those if needed for the 401k. We do have our own 401k. So we have a prototype plan that's approved with the IRS that you could adopt that does not require a custodian. So you could be self-trusteed 401k. If you're investing in, for example, if you're investing in syndications, this is one of the things that trips people up, is there is something called unrelated debt financed income that's assessed to an IRA that is not assessed to a 401k. And so when somebody does a syndication that has any debt in it, even if you're not in control of it, you still have unrelated debt financed income if you're investing through an IRA, and it's your responsibility to calculate it. A lot of people think the custodian does it and they just don't do it until the audit's upon them, and then they get hit with massive penalties and interest, and they wonder what happened. You can avoid that whole mess if you just set up your own 401k. So we do make that available to our clients as well. We do the estate planning. I'm a big believer in 200 to 300 year planning. So it's like, think way into the future, and it changes what you're doing today. Has a pretty big impact on people when they do that. It's kind of a weird mental exercise to say, where will I be in 200 years?
Yeah. So true story, and I'll apologize for anybody that's listening. Because of the topic that Toby just touched on, I want to hover on that. And in my slide deck, we had a question or two come in over the last couple of weeks. So my slide deck is out of order. Who cares? I want to spend a minute on this. So Toby, what is the qualification to create a solo 401k? My understanding was it's the anticipation of being self-employed. That may or may not be true. I'm curious what has to be in existence to do
any business. It could be a sole proprietorship. It could be an LLC. It could be a corporation. You just have to have a sponsoring entity, and you don't even have to contribute to it. Technically, you could just roll over an IRA into a 401k, and you don't ever have to actually contribute any additional funds.
Yep. Okay. So to drill down more on the benefits of the solo, is there an ERISA law that clearly states for an investor, UBTI, UDFI, you just simply don't have to worry about all that headache mumbo jumbo if it's a solo 401k? Because I literally, maybe 2 weeks ago, I was down in Phoenix and I was talking to a new person that's sniffing around Spartan. She's a sharp gal. She doesn't profess to have, great control. Well, let's just be honest. None of us really understand tax stuff except for the CPAs and the attorneys. So she's
I don't understand it either. They call it practice for a reason. It's the practice of law. It's not the perfection of law. We're just trying.
That's simply not true. But her point was, Ted, I'm worried that if I invest in a leveraged syndication, which means, Spartan, when we syndicate, we'll go out and take on 60% debt for an asset that we've purchased, which creates unrelated debt financed income. So how does an investor, how can they write the check for $50,000 or whatever with 100% confidence that they're not getting jammed up if it's a solo 401k?
Oh, because the law is that explicit. There's actually a provision that says this is UDFI, and it applies to IRAs, but that same provision does not exist for 401ks. So it's them saying, here's the type of things where this unrelated debt financed income is imposed, and the same statute or the same provision does not exist for the 401k.
Okay. So let's stick with the theme here for a minute. What if an investment provides 1099 income to an investment? Do you need to worry about, or let me say that differently. What if an investment provides a 1099? Does the investor need to be concerned if that is held in a retirement account, either a Roth IRA or traditional IRA?
The answer is no. So it's not. 1099 could be dividend. 1099 could be interest. 1099 could be other income. 1099, a lot of people think of as if I am an independent contractor and I'm doing hard work, then I get paid. That's called active participation. And it's not the 1099 that triggers the unrelated business income tax, the UBIT that you mentioned a bit ago. It's you're in a retirement plan that can't do active participation, and it's running an active trader business. And if that's the case, then they level the playing field, saying, hey, Ted, you can't run McDonald's in an exempt organization and not have to pay tax, while Joe over there, who has his in a for-profit, does have to pay tax. They level the playing field by saying, if you're both competing and you're both engaged in an active business, then there's unrelated business income tax on the exempt organization. That's all they're doing.
Yeah.
But if I have interest income, no. If I have capital gains, that's portfolio income, no. If I have royalties, no problem. None. If I'm a passive investor in a business, even if it's a McDonald's, like I could own shares in McDonald's, no problem. If I run the McDonald's, now I have a problem.
What about a plan level for a solo 401k? I'm under the impression that if the plan is not valued more than $250,000, there is no filing. Am I
correct? If the plan assets are below $250,000, there's no requirement that it file the 5,500. Okay. Here's another one: is if you have real estate and you're in an IRA, you have to disclose every year the existence of those assets with an evaluation that you have to, it's kind of like your best guess of what it's worth. But they want to know because they're used to people not paying UDFI, the unrelated debt finance income. You do not have that same disclosure with the 401k. But so as you're doing these returns, if you do, we recommend, whether you're required to or not, that you still file it, because it stops the period of time that they can come back and audit you. If you never file a tax return, even though you're, let's say you're at 200,000, if you don't file a tax return, then that door never closes in 3 years. You're just sitting there waiting to get, they can come back at any point and say, oh, we're going to come here and take a look.
Isn't that interesting? Yeah. That is interesting.
So it's not hard to do. 5,500 is simple. You just do them and close the door and say, go about my business and not have to worry about it. Yeah. If you're somebody who doesn't really care, the risk is minuscule. I think it was right around 1,000 audits for exempt organizations, and there's 1.7 million 501c3s out there. Like those are exempt organizations, 401ks, IRAs, defined benefit plans. There's millions of these. There's very few audits.
Yeah. So I read a couple of years ago that the IRS, let me say this differently. Recently, I read, and I was looking at the minutes from the meetings that the Department of Labor was having with the IRS with regard to taxable income. The IRS is trying to close the door on, they're missing a lot of tax revenues in these private investments. And so the DOL and the IRS were starting to formulate a plan on how to be a little bit more accurate and collect a little bit more of the unreported and unpaid taxable income. Have you read about that? Is that a thing that you've got your eyes on?
Yeah, so I've been reading the commissioner's testimony was really more geared towards people moving the money offshore and hiding it from the United States jurisdiction. They do say that affluent investors are really good about not paying taxes, but avoidance is not a crime. Evasion is a crime. So avoidance is using legal means to minimize your tax. And that's what most wealthy investors are using, which is, hey, if I have two choices, pay very little tax now and a little more tax later, or pay a lot of tax the whole way along, I may choose to minimize my tax hit now. There's nothing wrong with that. It's just making the election. So for example, in real estate, and I'm sure you guys do this, when your accountants are looking at your properties, you're probably doing a cost segregation. You're breaking out the components of the building and you're accelerating some of it. Some of it's 5-year, 7-year, 15-year property, or it could just be the default, which is 39 years for non-residential. So you look at that and you say, hey, do we have a tax appetite to accelerate these? Well, for some of your investors, the answer is probably, yeah. If I can get a loss that passes through on this and I have a sufficient basis, I would love it. And other people are like, yeah, it doesn't really matter to me. Then you exit, and when you exit, then if you have carryover loss, it gets released for those investors. For other folks, they may have a little taxable income. They may have a little tax on some of the recapture of that depreciation on the personal property. Or they may not, but it gets settled up at the end. But at the very beginning, you could end up acquiring a property and having a massive amount of loss, especially for the general partners or the managing members in these LLCs or however you're structuring it. So there's nothing wrong with that. So they try to demonize it sometimes. And it's like, no, you have to understand why the developer's doing what they're doing. Is you're giving them an incentive to do it. There's a reason they need that incentive, because there's a lot of risk in doing it. And when everything's going honky-dory like now, when it's, everything's on fire, everybody gets mad. But in 2008, they weren't mad. They were like, oh, I wish they would buy something. What's going on with this market? We can't get anybody to buy anything. It's like, then they had to incentivize them even greater.
Yeah. So let me like to circle back on one other piece that you mentioned on this topic of retirement accounts, and that is a lot of investors, when they're disclosing plan values, there's a lot of questions as to what degree do I do my homework to validate, the sum of the parts. Somebody might have, 2 rentals, 8 syndications, and, to what degree do they need to document, or do they even need to document how it was that they came up with the sum of the parts? Can you shed some light there?
Yeah, so you look at why the IRS is asking for it, and they're not asking for it to assess a tax. They're just asking for it to get an idea of how much plan asset is held in real estate. And then they're looking and saying, here's about proportionate amounts of how much real estate is encumbered and how much of that income that you're like, let's say that you're a retirement plan and you own $2 million worth of real estate in it, or interest in real estate worth $2 million, and you don't have any UDFI. The IRS is going to say that's almost non-existent. We don't see people doing that where it's not. So that's what they're looking for. Is they're just trying to see something completely off. And then they're just going to say, did you miscalculate this?
Yeah.
And so it's going to trigger a letter coming out to you saying, do you want to take another gander or provide us with, like, the K1s actually report now? If you look at the K1 that you're getting on a partnership, it's going to say the type of debt, whether it's recourse or non-recourse, and what your proportion of it is. So if you're, again, a retirement plan and you have a K1 that's reporting debt to you and you're not paying any UDFI, they'll calculate it for you, because they have the numbers. They'll just send you a nice little letter saying, we think you underpaid, and here's the actual amount of tax based off of what you did, of what was provided on your return.
What would you advise to somebody who has a self-directed IRA, has 3 or 1 or 7 private investments in it, where, part of the income is attributable to leverage, but they've never disclosed, they've never filed a return. And is it the 990T?
I forget what I think it is a 990T, the form that they're actually reporting, where they're actually reporting the unrelated debt financed income. Yeah. I could probably find out, but what I would say is roll it into a 401k and do away with it. Do away with the requirement.
Isn't that interesting? That's a good idea.
Yeah, 401ks are easy. If what the sad thing is a lot of there's a lot of the self-directed IRA companies that do the 401ks as well. They just may not be, they're not as profitable for them in the long term, because you don't require a custodian. So they may require a custodian, so that they want you to pay $300 or $400 a year. That's their model. They're just trying to get a little bit of money over a lot of years, as opposed to hitting you right up front. Yeah. Like, we just charge you one time, boom, you're done. Yeah. You don't need a custodian, run it yourself. If you need us to do the tax return, the 5,500, we'll happily do it for you, but they're pretty inexpensive. Yeah. Not a lot of expense associated with keeping a plan compliant. Yeah. Yeah. So
I think that's a reasonable resolution to probably a very prevalent issue that candidly the investors really don't know about.
Yeah.
So,
Accountants don't know about it.
well, yeah, that's actually one of the somebody. We had some interesting questions get emailed into us. Well, yeah. Okay, so I kind of got a little bit out of order, but let's run through just a quick. This is, folks, this is a shameless marketing pitch. I'm not great at marketing shamelessly, so I'll sprint. I'm very proud of Spartan. We have 43 employees. We syndicate a couple of different types of asset. Self-storage is where we spend 85% of our time. We made the Inc. 500 list. We're the eighth fastest growing private real estate company. In the bottom left, that's part of the team. We now have 43 people. Top right, that's our national brand. And Toby, I'm just going to fly through a couple of slides here to get you
perfect.
back to.
You guys ought to be proud, and you got to be saying, hey, when you build something that works, it's rare.
That's actually a thing. Yeah, it is rare. It does work. We've passed the fragile part of our company's growth, and this may sound a little bit arrogant, but I think it's a truthful statement. I think we're to the point where investors need us more than we need the investors, from the perspective that the real risk investors face is, what team do they bet on?
Mm-hmm.
And we're to the point now in our company's health that we're healthy and we're strong, and we could afford to do the right thing. And if we have a challenge, we're going to be forthcoming with it, and we always have been. Anyway, I'm really proud to be tied to Spartan. Here's a little bit of the team on the right. We do the soup to nuts. We run the program. We manage the properties, run the acquisition. We have our own construction company. That's us. Okay.
You do a great job. Like we work with people all over the country. We have over 20,000 folks out there. And I can just say, when you find good syndicators, like I've had Ryan on to go through the numbers. If anything, you guys tend to set the expectation a little bit lower, because a lot of people are just trying to, they're doing a dog and pony show trying to raise money, and they're making some promises that may or may not be, arguably going to be kept.
Yep.
If they're not misleading, but I would say that you guys have a very conservative way of approach, and my guess is that you've probably outperformed all of your expectations on your syndications.
Yeah, I'm comfortable with where we put the starting line.
Yeah,
Ben, our CFO, he is good at that. Okay, so our first question had to do with retirement accounts. I think we kicked that pretty hard. Let's move to question number 2, which is why I pounced on the solo 401k topic that you brought up. So we'll move past question number 2. And if I have an investment with a syndicator in a different state than where I live, do I need to file a tax return in the state where the investment is made if a passive loss is my only business activity? Okay, you get the flavor of this. What do you think here, Toby? What should investors expect?
Yeah, it depends on the state. And yes, you would normally have an obligation if you made revenue in a state, unless your syndicator is doing a composite return. And a composite return is done when you're touching multiple taxable states, and the partnership does it. And these are all partnership from a tax standpoint. I don't care what you call it, LLC, LP. They're all, from a tax standpoint, the IRS says, I don't know what it is except a partnership. Don't confuse me with this LLC language. I don't know what you're saying. It's a partnership. And so if you do the composite, ultimately you pay a little bit more, but you don't have to deal with it if the syndicator does it. But regardless, if there's a state tax owed, it's on the obligation is on the partner.
Okay. So do limited members have any say, or if they're uncomfortable with a consolidated return, is there any pushback there?
Well, it's a composite return, and not to correct you, but it's a composite state so that they're just paying it all. So the partnership pays it. And the amount of say they would have is the same as any of the financials. They have a right to look at the books and say you did something wrong and maybe point it out. But that's about it. But really what you're going to do is you're going to get a K1 and you're going to report it. I don't like that. This one number, they're not really going to come at you like that. At least not what I've seen. They're usually pretty happy if you're doing it. Like, oh, you did it. Now I don't have to do it. This is great. Otherwise, it's something that's built into most tax software. So if I get a K1 and and you're in a jurisdiction, I can't think of any off the top of my head that, maybe something on the East Coast. And it's like, oh, I have a tax obligation there. When you have a K1, the software is going to say, we need to file this return. Do you want to file the state at the same time? And it's only on that portion of the income.
Okay. What would that cost to file that return using a professional advisor?
Really? Okay. Done with the return. So it's as easy as I'm doing your federal return. Should I file this? Yes.
Yeah.
Kicks out another document. I mean, like some preparers may charge you for it. We don't. I mean, we just give you one. Here's the cost.
Yeah. Okay, good. Okay, let's see what is behind door number 2 here, figuratively speaking. Will depreciation losses from a self-storage syndication on a K1 offset 1099 interest income from a hard money debt deal? Okay, so passive losses versus 1099 interest income. The jury says no.
You just nailed it. So, so you have 3 types of income that's floating around out there. You have your active ordinary income. So you're like when you're working for your wages, you're sweating, you're doing the hard work, you're going to work. You have the passive, which is you're completely not doing anything, or you're investing in real estate. That's not a trader business. So it's rental real estate. Or you have portfolio income, which is everything else. It's your capital gains, your royalty income, your dividends, and your interest. So in capital gains, if I didn't say that, that's in portfolio income as well. So so we're breaking them out. And the big one is passive losses only offset passive income. So we have to look and say, all right, we're doing a self-storage, it's rental, so it's passive. I am also not a material participant, passive. So no matter what we call it, it's passive. So now it's flowing down to me as passive income. Passive income can offset passive losses. So let's say I have a whole bunch of depreciation, which is a deduction, and it exceeds the amount of income. So I'll have a loss. So I get to take my passive loss and I get to apply it against any other passive income. So if I'm a silent partner in an S-corp or another partnership, if I have other real estate income, I can use those losses against it. Now there's 2 big exceptions. If I can unlock my passive, and the code provision, by the way, is 469. So what I'm about to tell you exists in 469 subsection C7. So like if you want to point your accountant to it. The exception is if I'm an active participant in real estate and I make less than 150,000, that I can get up to $25,000 of loss, passive loss, and apply it towards my ordinary income, all my other types of income, even my capital gains, which, you might not want to do that if it's long-term. The other route is real estate professional. And there we don't have an income limitation. So for most people that are in syndications, you're over 150,000. So active participation is out the door. You're really looking at real estate professional, and that's a 2-prong test. Am I spending 750 hours a year, or one spouse, by the way? So this is like, if you look at a unit, it's one spouse on test number 1, which is 750 hours and greater than 50% of their personal services. So you look at it and say, if they're working 1,000 hours a year for somebody, you'd need to do 1,001 hours in real estate. It doesn't have to be your real estate. It's just construction, development, redevelopment, brokering, sales, being a real estate agent, whatever. It doesn't have to be just on mine. Second prong is, do I materially participate as a spousal unit? So in this case, we add up all the hours between spouses. Do I materially participate on my real estate? And so you look at all your real estate and say, oh, do I hit it? And then if you do, then we have to make a request to the IRS that we're going to treat all of our activities as one big activity. So we're going to treat all of my real estate as one piece of real estate, basically. If I don't do that, otherwise I have to materially participate on each property, which, if you know the test, can be a tall order. But if I do that, then any losses that flow down out of a syndication will offset. It will offset my other income, no matter what its source is. There's one caveat there, which is if you're in a limited partnership, where then we have this 10% test of gross rents, and we can go down the rabbit hole. But the easiest way to look at it is, hey, we have a couple of tests. Deal with an accountant on it that knows real estate. Don't try to figure all this stuff out on your own, because you're going to step on a landmine, because there's 9 different tests for material participation, depending on your scenario. And the first step is etched in stone. We have lots of court cases on it, 750 hours, more than 50%. Where people screw up is they don't consolidate all their real estate together. They don't make that election. Well, it's called an aggregation election, and they don't do it. So they treat themselves as a real estate professional without realizing now they have to qualify for each property. And number 2 is, they don't really look at the material participation. They don't understand what hours I can actually use and how easy it is to qualify under one test. And there's 9 different tests versus another. And so, whenever you're doing that, it's best to have somebody who does it day in and day out, just kind of look at your scenario and say, here's your easiest path. So Ted, I might look at you and say, oh yeah, you ought to, obviously you're qualifying here, but you have to do this, that, and the other. We might want to, bolster this to make our argument better. And here's the net benefit to you. If like I had a couple that was the wife was the surgeon and the husband was working, but getting into real estate. And they realized that just by him not working anymore and unlocking the amount of depreciation they had, that they were offsetting $300,000 a year in income. So on their tax return, they were saving upwards of $120,000 a year just by him saying, I'm not going to work anymore. Without doing anything else, they had a net positive, when you look at it and you're like, oh. And then he's like, yeah, I didn't, I thought we had to have the extra money. And it's like, sometimes you do the math and it's actually the opposite.
Yeah, that's actually, I could kind of see where you're going with that. I'd be curious to see how that was probably a fun conversation.
I was teaching a tax class, and I do something called Tax Wise a couple times a year. And I say, just take three ideas that you're going to implement. So I teach about 40 different tax strategies. And I say, here's the ones that are most beneficial right now, based off the laws. Pick 3. And I'm just like, just pick 3. So these guys were sitting in there. First one they did was, what we did is we did a cost segregation. So we broke some of their properties down in their components, and they were able to accelerate some of it. And they had these massive amounts of depreciation that they were just like, so they were accumulating real estate. What a lot of people do is they just keep accumulating, and they're just sitting around. They're writing it off over 27 and a half years or 39 years. They're sitting around, and they don't see any benefit to accelerating it. So they don't. And all we were able to do is unlock that. And then they had the light bulb go off. Yep. And the net benefit to them, it was $183,000 is what they saved in year 1. And they said that was the best 5 minutes we've ever spent in a seminar. I was like, they said, because it was funny. It was like right out the gate. And once they did the math, they were like, really? And they kind of showed it. I was like, yeah, that's what you can do.
Yeah, that's funny. I bet you have a handful of stories like that, but 183, that's a big number.
I remember the exact number. And then there was another kid who we were talking about. His accountant didn't understand real estate to the tune of, he didn't understand the difference between land versus an RV park that had all the hookups.
Yep.
And so that's almost all personal property when you have the hookups. And so it was a $1.3 million property. The cost segregation for year one was over $1 million. So the kid had gone to the accountant. He'd gone to a class, became our client. And I said, hey, you really ought to check this out. And the accountant was like, well, it's land. You didn't really do anything. And he came back and he says, well, I don't really know. And this is what was interesting. It was after the tax year. So like right now, we could still do things for 2020. Even though we're sitting here in 2021, we could still make a change of accounting election all the way up until October 15th. And so we were sitting there, I think it was in October. There was like a week left. So I called up my buddy over at one of the cost seg companies, a guy named Eric Oliver, really nice guy up in Salt Lake. And I said, hey, could you run the numbers on this? And they ran some conservative numbers. And the kid was like, oh, that is a benefit to me. Well, they ran the conservative numbers based off of any other structure on that property, not as the RV park. So they thought they might get him $280,000 of depreciation. They got him a little over $1 million. Yeah. You don't have to take it all right now. Like you could spread it out. You could choose to keep it as 5-year, 7-year, 15-year property. You don't have to take it all. But in this guy's case, it was a pretty big win because he had a lot of income. And he was like, hey, this is just the nature of the beast. He was selling a lot in 2019, and he had a lot of income because he didn't normally keep his properties over a long period of time. So he had a lot of active ordinary income. And he was like, whoa, this is going to knock away most of that. Like, that's going to be a pretty big win. Probably saved him $200,000-300,000.
Wow. Okay, so a minute ago, I want to go rogue here for a minute. So a minute ago, you mentioned that this class that you teach, there's like 30 different subjects that can be focused on, mm-hmm. and that you ask people to just focus on 3 somehow during this class.
Yeah. Because otherwise they'll get sensory overload, and it's just like pick 3, come back next year, pick another 3, come back next year, pick another 3. You're going to be pretty lethal by that time.
So we've had 2 examples of real wins. Can you think of a third example different from the first 2 that it was just a shocker that it is real life stuff?
Yeah, I could tell you a really good one. So it was a West Point grad.
Oh,
and
cool.
he was a pilot. So he was a type A personality. So he'd been in here in Las Vegas. He was president of the local angel organization, which is, they do a lot of private equity. And he came to my office, and I still remember it. I ended up buying his accountant's office after all this. His accountant was this older guy named Ben, and Ben had this really high pitched voice. Like he sounded like this. So I still remember the conversation. You'll understand why. So I'm talking to him, and I'm looking at him, and I'm like, Mark, based on what I'm looking at, you're overpaying your self-employment tax by about $25,000 a year. Here's what I would do. I'd make this election 1 form, and you could actually ask your accountant to do it, and it's free. And he looks at me and goes, you're telling me if I do this 1 form, it's going to save me $25,000 a year. He goes, I don't believe you. And I go, call your accountant. It's not hocus pocus. We're just changing. Like, he had a lot of income coming in as a sole proprietor. I was like, you have an LLC. Let's just make an S election. You file a 2553. There's nothing else that we have to do. And then you start taking a small salary out once a year or quarterly, whatever you feel like. So he calls up the accountant. The guy's name is Ben. And so we get him on the phone, and Mark is sitting there going, Ben, I'm sitting here talking to this lawyer, and he's telling me that we should make an S election. And I said, I've been operating this way for 20 years. Why would I make that change? And he says I should make the S election, and that I would save, based off of last year's number, $25,000. And Ben says, yeah, that's about right. And I watched Mark just turn like a shade of purple.
Yeah.
And, it was, and he was kind of like, I think the exact quote was, why didn't you tell me this? And Ben was like, you never asked. But he said it like this: you never asked. You never asked, Mark. It was pretty funny, but that's not even anything major. That's just recognizing that you have 2 choices. It's people set up an LLC. They don't realize that the IRS doesn't recognize LLCs. They don't even know what they are. They're like, oh, it's an LLC. You get to pick whatever flavor you want it to be. It could be a C corp, S corp. It could be a partnership. It could be disregarded, which means we ignore it. Like there's a lot of flavors. You get to choose. And if it's in your best interest, quite often, you don't realize that you have an option that's in your best interest. So you're looking at it going, you mean I'm overpaying? And then the funny part of overpaying is that usually you're in a higher audit risk. And so in Mark's particular case, he was in about an 800% greater chance of audit. And the audits in that category, the IRS won 94 to 97% of the time. So I showed him the data, and again, you show a West Point grad, they're usually pretty much like, just show me the number. So I just got data book, grab it, put it up. At the time, S-corps were being audited at 0.03%. Larger sole proprietorships like his were being audited at, close to 2.6%. So I was like 0.3 versus 2.6, more than 800% more likely to get audited. And I'm watching him again, just lose his mind. And when you do that, by the way, we can actually do an accountable plan. And now all these things you can't write off, now you can write off. And here's some examples. Like if you're a sole proprietor, you have to break like one of these little cell phones, you have to break it down into which portion is business, which portion is personal. You got to figure out all that stuff. You can do a home office, which is really hard to take and is a big audit trigger. You could do these things, but as an S-corp, I can just reimburse, not report it anywhere. I show it as an expense on the S-corp. I don't have to report it anywhere for me, but I get to do 100% of this. Yeah. And I get to take a percentage of my home plus depreciation. And I can reimburse myself. And in real life, what it means is something that would give you about a $750 deduction turns into a $5,000 to $7,500 deduction just by making a tax election. Plus, S-corps don't pay Social Security tax on their profits. So just that one document on this guy was saving him $25,000 a year, like that, without even trying. And it took me all of about 6 seconds when I looked at his thing to say, you're doing this wrong.
Yeah. So I'm gonna go ahead and venture to say that considering that this is a free webinar, the last 2 minutes was well worth the price of admission. But that's bananas, what I just heard. I mean, I didn't know that not like I'm some hotshot tax gee whiz kid, but that was really interesting. That was very insightful.
It's about 70% of the businesses are set up incorrectly. 70% plus, like I'll say conservatively, 70% of the businesses, in my experience, are set up incorrectly, but the numbers don't lie. Like if I can pull up the IRS data book and I could say, there's many millions over here just getting torched and they're losing all their audits and it's predictable. Why are they still doing that? Yet that's the most popular form of setting up a business. Mm-hmm. I just look at them and I go, that doesn't make a lot of sense.
Yeah.
So somebody's not looking at the numbers.
Well, I'm glad we went rogue. That was definitely, worthwhile. Okay, another question that came in: how are commercial real estate properties assessed for tax? Are the comps or cap rates related?
It's commercial. Sure. It's almost always going to be cap. They call it an ad valorem tax. I don't even know why that's popping into my head. It was kind of like what you do is they're literally taking your profit, your income statement, and they're dividing it by that particular county's cap rate. Okay. And that's how they're going to get your fair market value. Interesting. I wish it was more exciting than that, but that's literally how they do it. It's like the same way we would do it. If we said, hey, what's a cap rate? We're not going to do comps on a commercial building. You nuts?
All righty. What's this so high?
Oh, that's a good one.
Yeah.
In order to learn to do anything, you have to do it. So one of my favorite things is this thing called Baader-Meinhof phenomenon. And it's based on this article of this far left group in Germany that started getting written up in the paper. And as soon as they mentioned it, everybody started seeing them everywhere. So the way our memories work is when something is irrelevant to us, our brain will block it off and not show it to us. So for example, if I walk into a room, I may notice there's a window. I may notice a door. I'm probably not noticing the pattern of the carpeting, right? And, or how many outlets there are, or how many light bulbs there are, right? Unless it's really dark, because now it's relevant. But otherwise, when I walk into a room, I'm probably not aware. Like my body sees it, my brain sees it, but it kind of blocks it. So this Baader-Meinhof phenomenon, or also frequency illusion, you experience it with cars. We've all done this, where you look for a new type of car. Like, let's say, hey, you're talking about getting a new car and you think Toyota Tacoma. I really like that Toyota Tacoma pickup truck. Drive around town and guess what you're going to see everywhere?
Yeah.
Toyota Tacoma, because your brain is now looking for it. Or playing slug bug as a kid, if you ever did that, where you punch your brother's arm, or and you see a slug bug, right? That's all it is. And the only way it becomes relevant to you is if it actually has an impact on you.
Yeah.
So if you're a CPA and you don't invest in real estate, most of it's irrelevant. So you could see it. It could be right in front of you, and your brain's going to do this, right? I still can't see it. I could have the same conversation with a well-intentioned CPA 10 times, and they're still not going to get it until they go out and start investing. If I mention, like we started off on IRAs and 401ks, a lot of people are probably like, oh, that's great, because they're not investing through an IRA or 401k. It's not relevant to them. It's not going to become real until, but if you're somebody says, hey, you have UDFI, well, where is it on the K1? Like, there's a box there. Oh, all of a sudden you start noticing these things, right? Because it's relevant to you. So why is it so hard to find a good real estate savvy CPAs? Because you have to find one that actually does what you do.
Yeah. I think you hit the nail right on the head. That the car analogy. I have two kids that are now driving age, and it doesn't matter. That resonates.
Like, you got to be careful with them driving kids.
Yeah.
Get them something that's safe.
Well, I won't go there, but that is an astoundingly good piece of advice.
Yep. Because the chances are they're going to bump into something once.
And
the chances are in your favor that you're going to be using your insurance, and just make sure they're in something really good that they can't harm themselves and hopefully not harm others.
Yeah. So the short story is, my dear wife, we have a new Honda Accord, and the scratch on the front bumper that is attributable to my daughter is nothing compared to what it could have been. So,
yep.
Love the Honda. So anyway, okay.
What you say is, you go, thank God, like, we're pre-disastered. She's already done it, and it's just a scratch.
Yes. Yeah, exactly. Okay, so if a fund gives you the option of filing a composite return, this kind of came up earlier, letting an individual say, what are the advantages and disadvantages of these? I think we kind of touched on this earlier, but maybe take a poke at it.
Yeah, composite is, now I don't have to do it. That's the advantage. I don't have to do it now. The fund is taking care of it for me. The disadvantage is I might pay slightly higher than if I did it individually, because they're going off of kind of the highest denominator here of what they think could be owed. So they might overpay just slightly if they're doing a composite return, but who cares? I don't have to do the return. I don't have to worry about it. Thank you for handling it.
Good enough. Okay, is there for LLCs, is there anything special we need to tell the lawyer to do with regard to tax issues?
Yeah, hire a good CPA. I'm just teasing. Yeah, no, the same scenario. LLCs don't exist for tax purposes, so run through different scenarios. And these folks work for you. Don't let them lead it. Say, what about this? What about this? What about this? And well, again, I don't want to go back to what I teach, but I'm always telling people, say, get rid of the kind of the request, the can I, and start using the how can I instead. Just throw that extra word in there. And so, how can I reduce my taxes with my tax selection? Don't just sign off and say, oh, whatever it is. there's another side to this too. So if I'm setting up an LLC for Spartan, for example, if Spartan was going to go in and buy something, we know they're going to exit. So you're going to have financials to back up what the sale price is, not for you, but for the party that's going to buy it, because they're probably going to get financing. And so you're giving them a return so that they can qualify. Now, let's say that, Ted, let's say it's you and you just say, you know what, I'm just going to buy this park. I don't even need anybody else. Well, your attorney could say, oh, we'll set up an LLC and we'll make it disregarded for tax purposes so you don't have to file a tax return. Well, I just did two things there. Number one, I took a reporting that would be on page 2 of your Schedule E, where Fannie and Freddie will give you 100% of the net income as credit when you're applying for a loan. And I moved it onto page 1 where they'll give you 70%. That's number one. So I just moved the form that it's going to be reported on. And number 2, I just disqualified anybody who's going to try to buy my property that needs to get financing, because I won't have a 1065 to give them to show that individual property tax return. And that's going to kill a lot of deals. And we've seen it over the years. People have a real frustrating time selling a property when it's showing up on page 1, if it's a commercial property, especially if it's on page 1 of your Schedule E and you can't give that the purchasing party a 1065, they can't get through underwriting, or the underwriter gets nervous and starts adding additional basis points. Like all of a sudden it's more expensive. Yeah. And you price them out and you'll end up having deals fall through as a result. You kind of like, this is why, again, it's so important to work with people that actually do this, because instinctually, like I do this because I deal with it, right? If I want to get financing on something, when I'm targeting a property, I need to make sure that I can back up the story over the last few years to my lender. And if it's some guy that's been just putting it on his 1040 and playing games, you God knows what, not reporting everything, hiding the deposits and all that, good luck. That property is no longer a target for me. If I see that, we're walking away.
No, that's interesting. I miss that. Good advice. Advantages and disadvantages through an LLC. How much of the fees to set one up? This is it kind of dovetails. Tie it together for us.
Yeah. So the question there, and I'm not sure if it's me using an LLC to invest in real estate or me using an LLC to invest in a syndication. So let me hit both. Number one, real estate is a combustible asset. It could blow up on you, right? We want to make sure that we don't put it with my house and all my belongings and my bank account. So I'm going to put it in a box and I'm going to separate it, and I'm going to use an LLC. And an LLC is a fantastic box to isolate that combustible asset. So that's an easy one. So when you do a syndication, it's almost always going to be an LLC, because you're compartmentalizing it and you're making it to where we can have lots of owners of the box as opposed to everybody's a tenant in common on it. Number 2 is what happens if I'm an investor, and I'll give you a real life example. This just happened last night. So I'll quite literally, I had a client text me at about 9:00 last night because she was on Facebook and she read about the death of one of her investors. She was in Bali. Like, you guys could probably figure this thing out pretty quick. She fell off of a cliff and fell in the water, and the fisherman found her. U.S. tourist. So like that's somebody that's invested with a syndication with somebody else. And so they're reaching out going, oh my God, what do we do? Right? Because that individual has an impact on the actual syndication. So the same way somebody could pass away, they could also get a divorce. They could get into a car accident. They could get sued. They could do any number of things. And what is that impact on the investment itself? So syndicators are used to dealing with this, and they say, all right, you're going to be passive. But, so like I already know what the issue is. If it's somebody who's an individual investor, well, then I'm going to have to do with their estate, or we're going to have to find out whether we'll need a death certificate. We'll need a certificate of trustee if they have a trust. If they don't, then we're going to need an executor to get a document from the court for them to even be able to communicate with the syndication, right? So there's always that outside pressure too. When you're an individual and, maybe you are looking at it saying, I want to make sure nobody can take my stuff away, then we may want to pick a box, an LLC, and put it in a jurisdiction where they can never take away my box. If I'm in California, for example, and I own a piece of real estate in an LLC, they could take away my LLC and sell it, liquidate it, and take my property. That same scenario, if that LLC is in Wyoming, they cannot. If somebody says, well, I have to have a California LLC. Okay. You have to have something. I may not agree with you on that, but I would still have it held in a separate box out of the state. Well, I have so many investments. I have 100 properties, all in different LLCs. I'm not going to all put them all in Wyoming. I'm like, you don't have to. You could just take your ownership and put it into a Wyoming LLC, all those other LLCs all over the country. So you have syndications in Texas, Georgia, you got properties in North Carolina and Indiana. You could just put those all in a single safe, a little box that's protected from you. And all the while you're protecting yourself from those actual assets. It's actually really, really simple. It's so easy when you look at it and you break it down like that. But boy, accountants and attorneys screw it up over and over again. I see this all the time. And I'm like, why did you leave that person exposed? Like, for example, you, Ted, you have 2 teenage kids. The last thing I'd want is for you to lose your entire life savings because that scratch wasn't a scratch. It was actually, she hit a busload of nuns and took them all out, right?
Yeah.
My mom hit a school bus, by the way, that was parked.
Too bad.
It was like, Mom, how did you do that? It was empty, but she just ran into the school bus. So I could always tell people, hey, my mom ran into a school bus. It wasn't moving and it didn't have anybody in it, but she still ran into
it. So a couple of things come to mind. Spartan is fortunate to deal with a lot of well-to-do investors.
Mm-hmm.
Physicians, they've got that tail risk where something might come crawling back out of 2 years ago, and so I think this is actually really relevant and valuable. So Toby, to somebody who, the 40-year-old, 45-year-old physician who's starting, $400,000, $600,000, couple million in net worth. I've got like 3 questions I'm trying to ask. How do they start with you? I mean, what
they always come up with it. Like, it's actually really, really, really simple when you break it down. So the best example I could give you is if you've ever been walking around your neighborhood at night, like maybe you're going for a walk and then sun goes down and you realize that you can pretty much see into all your neighbors' houses, right? You could always look like everybody, you may as well have a whole street of fish bowls. You could see, oh, there's Joe, but because you could see right in. Well, let's say that the neighbors weren't there. The door was open and there was $1 million sitting right in the doorway.
Yep.
Some people might be inclined to go help themselves to the $1 million.
That's a safe assumption.
Right. So the first thing you do is you shut the door and you turn out the lights, right? And if you're not home, maybe put down the blinds. So you're trying to protect it. But the $1 million is just behind a door. All I have to do is open up the door. So where are you going to put the $1 million? And most people are going to say, well, I'd put it in a safe. Like, would you leave $1 million lying around your house? They might say, no, I'll put it in a safe. Still not safe. I actually had a safe removed from one of my houses once. I had my windows done in Seattle. And a week later, I came back and one of my safes, I had one that was in the back of a closet that was anchored in, was missing. So somebody came back and helped themselves to the empty safe because I practiced what I preach. I didn't have anything in there that was worth anything. I used it to keep one firearm. And so they got a cheap cruddy old Colt, it's like, great, you got that. But that safe could still walk out. So what I tell people is I like to bury the safe out in the desert. Like if I'm going to put $1 million in it, but I don't want the trouble of having to go and dig it up, right? Having a safe in the desert isn't exactly convenient. So we have this beautiful internet thing where we can have a safe in Wyoming. We can have a safe in Nevada. And I say a safe, but what I mean is an LLC. That is where I store my stuff. That's where I put my $1 million. And the reason I do that is because nobody can take it in my state. They cannot come into my house. I can't have a court can't say, Ted, you're going to give me that interest, because you're going to say you don't have jurisdiction over it. You're going to have to go out to Wyoming and get that court order. And Wyoming's going to say, our statute says the only remedy that you have against this LLC is a charging order, which is a lien. So you can lien it, but you can't sell it. You can't foreclose on it. You can't take it away from them. And if it has $1 million in it, that means you're still in control of the $1 million. Easy. You just do that once. So simple, but gets missed. You can't do it after the fact. So same thing with a doctor. If they don't put that in place and they get sued, too late. They put it in place. They have it in there for 20 years and they look at us cross-eyed and say, hey, why have I been doing this for 20 years? You're like, you pay insurance for 20 years, right? You're putting it there in case you need it. Hopefully you never need it, but it's there if you do. And you'll be really, really, really thankful when you do, because we've actually had, we had one client during the recession that got sued for $32 million. And we were able to settle that thing for less than 1.5, and they were dead to rights. And the lawyers literally said, this is a tangled web. So we're going to give you an offer that we believe is reasonable under the circumstances. And, you look at it and you're saying you're not trying to hide away from liability. You should still settle out, your obligations, but you're not going to be a victim in it. You're not going to put yourself in a position where they're just taking things from you because some judge, somebody in a black robe says they can.
Yep. Powerful stuff. Thank you for that.
Mm-hmm.
Okay.
You guys have some good ones.
Yeah. Can you 1031 exchange capital gains from one syndication to another?
So the answer is yes, you can do it, but the syndication would have to agree to do it. It has to go name to name.
Yeah.
So the syndication would have to say, hey, all you investors, we're going to buy a new one. We're going to meet all the rules. Usually they're doing a starker exchange where you have to identify a property in 45 days and close in 180. You could do a reverse exchange where you say, hey, we're going to buy something else. Then we have to sell it within 180 days, which might be a little tough for commercial. Or if you're doing a syndication and you have somebody who's, Mr. or Mrs. Bigwig, and they really want to do 1031 exchanges, then you let them be a tenant in common. Yep. And you break them off a piece. They can't be a partner. You're going to be walking a tightrope on that one. I'll just tell you, because you're in a gray area. But technically they could do that. So the answer is you have to go name to name on a 1031. So if you're an investor, you're not the owner of the property. You're an owner in an LLC. The LLC is the one that has to do the 1031 exchange.
Copy that. All righty. I think we're getting down to the last 3 or 4 here. No, the last 2 or 3. So I threw in a couple that I now and again I'll get a random thought that I think might be halfway okay, like smart-wise, but I'm not totally sure of it. Mm-hmm. So I figured I'd ask Toby. So I, over the years, the unified credit exemption has gone up, and I can't remember where it's at now, 11 something or whatever.
You're thinking about that. You're talking about the gifting, right?
Correct. Yeah. So if somebody has an asset, or if somebody has an asset level and they're starting to, maybe they're 65 or 70 and they're starting to think about, how they want to, start to transition, can you gift a syndicated asset and dig into your exemption? Is that something that investors can do?
Yeah. So in most syndications, you're going to have a restriction on transferability. They'll allow you to usually transfer it into an estate planning vehicle like a living trust, but I doubt they'll let you give it to one of your kids.
Okay.
So most syndicators are going to say, hey, we're dealing with you. Ted, we're dealing with you, but if you give it to your daughter, she's not an accredited investor. She's not going to be qualified. We don't agree with it. We're not going to allow it to transfer. So there's a little bit of that. What you're really looking at is, I want to get it out of my estate. And should you be gifting this type of asset? So here's what I would say. When I have highly appreciated real estate, I get a step up in basis when I pass away. And I shouldn't say I do. My estate, the value of that asset steps up, and my heirs can sell it with zero tax liability. So I don't want to lose that. If I gift it to them ahead of time, they get my basis in it. So they're going to get a tax bill. What I like to do is, if I want to get something out of my estate, I'm usually going to give it to a foundation or a 501c3. And the reason being is because I get a deduction based on its fair market value. So not only am I getting it out of my estate, but I'm going to get a big fat tax deduction at my highest bracket for up to a third or 30% of my adjusted gross income, or my actually taxable income. So I can look at it and say, hey, if I'm making $500,000 a year and I give a syndication that's worth, I bought it for 50,000. I get an appraisal after 2 years and it's worth 100,000. I get $100,000 deduction. What is that worth to me? About $37,000. How much did I put in the thing? $50,000, right? So I'm getting a pretty good benefit back. Now it's in the foundation. Well, if I die, it's not part of my estate, and and my kids can still run the foundation. They get paid a reasonable salary. They could get business benefits, perks. They get reimbursed for expenses and things like that. So me personally, I love using trusts and foundations and charities because it accomplishes so much, and nobody can ever take it from me. So I could go again, hit the busload of nuns, and nobody can take my charity from me, and my kids could still work for it. Mm-hmm. I went to Catholic school, so I always got to run into the nuns. I'm still a little sore about the wax on the knuckles and the erasers that hit me in the side of the head.
I did too. It's all good. Okay, well,
objecting. You're not saying, hey, don't run over the sisters. No, they're good. We don't want to hurt the nuns. They're really nice people, actually. So no, but I'm just saying that if you had a big liability, so if it's a doctor and you have that one patient that decides to nuke the world, they're going to sue everybody that caused an issue. It's not even something I have to worry about. It's already in the charity. I got a big fat tax deduction. It's going to the next generation regardless, or going to be used for whatever the charitable purpose is. And by the way, people don't realize IKEA is a flipping charity.
I did not know that.
IKEA is broken into three components, and their in their retail and their intellectual property is held by two charities in two different countries. They pay an aggregate of about 3% a year. The family, Ingvar's family, has a third, and they have a little piece on the board, but they can't sell IKEA. He always worried that they were going to break apart his baby and sell it off. And so they're not in control. That thing ain't going anywhere. So we're going to have the puzzle furniture for the rest of, for an eternity. So it'll be annoying people in 500 years. Let me buy a shelf, and I'll spend 10 hours trying to figure out how to put it on the wall.
I saw that movie. Oh, shucks.
You don't have enough frustration from watching the news nowadays. Go buy a real difficult piece of furniture at IKEA and drive yourself nuts.
Before you do that, stick your hand in the desk drawer, slam it hard 3 times, and then straighten.
Probably help.
Yeah.
And then if you can find that last screw, please let me know where it is. I'm still looking for it.
Okay, so last one. So last summer, the Department of Labor allowed for private investments in 401ks, the age-weighted, target date maturity funds. So what about family? If there's somebody here that has a family foundation or has a charitable trust, maybe they're the trustee or they've hired a foundation to manage it. I mean, can that kind of money, can it find its way into private investments?
Of course, absolutely. Look at the California Teachers Union. That's an exempt organization, and they own big swaths of real estate. CRTs, usually we're using a charitable remainder trust very sparingly these days, and only when you have really highly appreciated assets and you want to get some tax benefit and spread it out the income over a period of time. Usually that foundations, you can do whatever you want inside them. You can invest in stocks, you can invest in real estate. They're a lot of fun. And here's the big thing, that there's charities that do something and there's foundations that give away money to the groups that are doing something. I tell people, do the charity. Like, don't do the foundation. The foundation means you're supporting everybody else's. If you like real estate, there's nothing wrong with doing real estate inside of a charity. You could do, like, what's the cool one? It's anything that's HUD or below, or veterans housing, single moms, all that is a charitable activity. So like, you could actually during your lifetime write off and deduct a house, wait 30 years, give it to your charity, let the charity start getting that income. You get a huge tax deduction. Do that every year until you've depleted your real estate. You get a big fat tax deduction. It's now in the charity forever. Again, your kids could work for the charity. Just think Chelsea Clinton.
Yep.
Right? They could just sit on the board. They could take a salary out, and it could be something that just goes on for an eternity. And it's way more beneficial than you realize. Like, I use Hershey as an example when I'm teaching. The Hershey Foundation was set up in 1905. He set up the Hershey School, which still educates over 2,000 parentless kids. Used to be if you were an orphan boy is what it started, but now it's if your parents are incarcerated or you're an orphan, obviously they're still taking care of people. They have a hospital, they have a cemetery, they have all these things in Lancaster County. That charity has grown in value to almost $13 billion. You literally can't get out of the way of these things when they start growing because there's no tax. They just keep doubling and doubling. Just think about it. If I had a bunch of real estate sitting in a charity, I don't have to worry about depreciation anymore. I'm keeping 100% of the income. And get this, I could apply for an exemption on the real estate taxes too. So I don't even have to pay my county. So I go from an 8 cap to an 11 cap simply because I don't have to pay the tax anymore to these local jurisdictions. Well, what ends up happening in my experience, because I've done about 4,000 charities at this point in our firm, people put money in the charities. They always worry, well, how am I going to get it out? I've never seen people with an appetite to take it out. I have one client I'll say that still draws out about $60,000 a year in salary because that's just what he does. It was his grandfather's foundation. And he actually chooses to treat it as a private foundation. It's not doing anything. He gives away some money, but he just runs it. But he takes a small salary out. That's the only one. Everybody else is pretty much just jamming the money in. And these things just keep getting bigger. And they're doing amazing things with them. And I'm always like, that's cool. Like, get your family behind that. Don't give them something they may not be prepared for, or don't give them something that, a bad divorce or a bad accident or in addiction, or just, maybe they're just immature. Don't give them something that they could lose and feel bad about. Put something away that really they can't screw up. And over the years, what I've seen is it's treated like with reverence. These people don't sit there and try to rate it and try to figure out how to get the money out. They look and say, oh, wow, this is what we do as a family. We have this really cool charity. Like, we're doing low income housing for veterans and stuff. And you'd be surprised at how innovative people are that never had any background. When they start seeing some of these things, they really sink their teeth into it. I just think it's amazing.
Well, Toby, I'm getting tired.
Ted, I'm drinking coffee. That's why I'm like on the ceiling right now.
Hey, thanks for participating. Thanks for sharing your experience and your wisdom. So friends and investors, that's our man, Toby, and that's where you're going to find him. And so Toby, we're going to email this out to our 3,000 person investor network. And I mean, thanks. We'll talk with you soon. And I think we're going to call it here. Anything you want to say?
No, just thanks for having me on. And, and it's always fun to work with real estate investors, especially people that see the wisdom in doing the syndications, not trying to do everything themselves, but sometimes supporting organizations that can do things as a group better than we can just do it by ourselves. So, you guys are awesome. I've always loved working with you guys. So you're with a good group. If you're hearing this, really good group with Spartan. And I know that there's lots of choices out there, but I tend to pick the groups that have integrity over the ones that make outlandish promises any day. So I just think you guys do a great job.
Appreciate it. Hey, well, we will talk soon. Thank you, everybody, for attending, and have a good evening.